Things are heating up on the global stage. The China-US trade war is back in focus as the two parties have agreed to meet this weekend, and it could shake up the markets. Plus, the Fed just gave their latest rate decision. What does it mean for your money? Google takes a hit after Bombshell Apple testimony, and we've got jobless claims data still ahead this week. We're breaking it all down, and don't forget, Investor Series Part 2 drops this weekend. Make sure to like, subscribe, follow us wherever you get your podcasts so you don't miss a beat. Now, let's get into it. Back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe help you make some money along the way. I'm your host, as always, Brandon Shar. Happy Wednesday, everybody. We are smack dab in the middle of the week, and boy, oh boy, do we have a lot to get into, so let's do it. Let's kick off the show with a quick check-in on the markets as of today. Let's take a look at the heat map for those on YouTube. For those who are listening on, iTunes or wherever you get your podcasts, essentially what I'm looking at right now is a lot of green, which is great, with the exception of Apple and Google, which we'll get into in a moment. Let's do a quick check-in on the S&P 500 SPX. We did manage to close a little bit above 0.4% today, which is great. We did close above 5,600. We were able to hold that level, which is awesome to see. Still below the 200-day moving average, though. Want to see if we can make a push above 5,650, and then, of course, above 5,700 as we approach that 200-day moving average. But we are above the 50-day moving average, which is great. And if we take a look at the ETF that tracks SPX, which is SPY, we are above the 50-day moving average, but of course also below the 200-day. But we are holding steady here. The ETF SPY essentially finished the same as SPX, which is its underlying, a little bit above 0.4% at 0.42. So that's good to see. Let's do a quick check-in on the NASDAQ 100, tech-heavy NASDAQ. And as of right now, that is just a hair below 0.4% at 0.39%, and also above the 50-day, but below the 200. So we're kind of in this middle no man's land right now, trying to see if we can clearly get above the 200-day, or if we're going to, continue to puke as we did back in basically March, right? Really since the beginning of the year. But as of right now, things look okay there. Quick check-in on the VIX. So the VIX, as I've said before, you want to see it below 20. That shows confidence in the market. Right now, we are above 20, but it has been coming off really ever since, the beginning of April when we got the tariff news. I mean, we saw highs up around 60, which is absurd. We did finish today just a hair above 23 on the VIX, which was down today 4.89%. So love to see that. Want to see the VIX continue to come down, and want to see the markets continue to stabilize. And I believe that will come as we continue to get some more clarity on where we stand. So let's take a look at what's really leading the headlines right now. It's the global macro tensions, folks. China and the U.S., they have been going back and forth, tit for tat, as far as tariffs are concerned. And we finally got some news that seems positive. I said probably about a week and a half ago, 2 weeks ago, if I had to bet, we are closer to a resolution than not. I was essentially saying, you know what, I bet in the next couple weeks we're going to get some talks, and sure enough, we're getting them. So that's great to see. We did get a notice on Friday that got leaked from China that they were basically willing to come to the table. And we did find out Tuesday evening, which sent futures soaring, of course, and really, the Asian markets and really global markets at large, that the U.S. and China are, in fact, taking the first steps to essentially seeing if we can come to some agreement on trade. So according to Reuters, U.S.-China to hold icebreaker trade talks in Geneva on Saturday. So U.S. Treasury Secretary Scott Bessent and Chief Trade Negotiator Jameson Greer will meet China's economic Czar He Leffing, I hope I pronounced that right, probably not though, in Switzerland this weekend for talks that could be the first step toward resolving a trade war disrupting the global economy. News of the planned Geneva meeting, first announced by Washington late Tuesday, sent U.S. equity index futures higher. Stock markets in China and Hong Kong followed suit during Asian trading on Wednesday. So the talks come after weeks of escalating tensions that have seen duties on goods imports between the world's two largest economies soar well beyond 100%, amounting to what Bessent on Tuesday described as the equivalent of a trade embargo. So negotiating teams conveying in Switzerland, known for its neutrality, are expected to discuss reductions to the broader tariffs, two sources familiar with the planning said. So this is big news for a situation that has really just had everybody holding their breath for what seems like an eternity now. So it is good to see that China and the U.S. are meeting in Geneva this weekend to essentially begin the talks. So we'll see what comes of it. I've heard that China's really been under pressure lately. I mean, China, if you think about it, they export a ton of goods to the U.S. and basically they've been in a position where they have needed to cut rates, inject money into their economy to offset these tariffs that have been imposed by Trump and the administration, and could face tons of layoffs to their labor force if a deal doesn't get done. So there is pressure on China. Equally, there is pressure on the U.S. as well. Don't be fooled. We're going to start to feel the impact of imports really starting to diminish. So this is the beginning, hopefully, of a trade deal getting done. And it'll be interesting because Trump has said since this news came out, he has no intentions on lowering the tariff, the 145% tariff on China. And China has also continued to say what they have always said so far, which is that if the U.S. wants to show sincerity, they need to drop the tariffs. So you essentially are going into this meeting this weekend in Geneva with, those two, storylines on either side. So it'll be interesting to see what the impact is. Obviously, we're going to get more news after this weekend. And look, this is obviously not going to be a one-time thing where everything's going to get smoothed over. There's a chance we don't really get any new information after this weekend. Multiple meetings. So with global tensions rising, the Fed's latest decision lands at a critical time. So in addition to that, folks, today we did get a Fed rate decision from Chairman of the Fed, Jerome Powell himself. And it was basically a nothing burger. I mean, we really didn't get anything new there. They kept the Fed rate unchanged, which was expected. And really what we were looking for were any hints from Jerome Powell as to whether or not we could see a rate cut in June or July. And really, I don't feel like we got a whole lot today, unfortunately. According to CNBC, Fed holds rates steady as it notes rising uncertainty and stagflation risks. The Federal Reserve on Wednesday held its key interest rate unchanged as it waits for the Trump administration's trade policy to take shape and sees its impact on a sputtering economy, in a move that carried little suspense given the wave of uncertainty sweeping the political and economic landscape. The Federal Open Market Committee held its benchmark overnight borrowing rate in a range between 4.25% and 4.5%, where it's been since December. The post-meeting statement noted the volatility and how that is factoring into policy decisions. Uncertainty about the economic outlook has increased further. The statement said the committee is attentive to the risks to both sides of its dual mandate and judges that the risks of higher unemployment and higher inflation have risen. While the statement did not specifically address the tariffs, Chair Jerome Powell addressed the issue at his post-meeting news conference. Stocks briefly ceded some gains after the rate announcements, but mostly recovered, with the Dow Jones up nearly 300 points, despite some worries over the Fed's characterization of the economic risks. So we didn't get a change. And I think right now, a lot of bets are on a July cut based off of, Jerome Powell's tone today. And, as an interesting side note, there's basically been this tension, of course, between Jerome Powell. Trump obviously wants rates cut, and obviously Jerome didn't do that today. And a reporter essentially asked Jerome Powell if, he would be willing to give or has given any type of fiscal policy advice to the administration. And he essentially said, no, that's not our place. We wouldn't do that any more than we would expect the administration to give us monetary policy. So a little tongue-in-cheek from Jerome Powell, which I thought was kind of funny. Obviously, he's privy to the news and how Trump feels about him. And, basically, he's essentially just saying, look, the Federal Reserve has one goal. It's monetary policy. That's their task, right? The administration, Trump's administration, those on the Hill, their job is fiscal policy. That's going to be anything like taxation, right? And tariffs, things that they're doing right now. So Jerome Powell was just in a very tongue-in-cheek way essentially saying, look, our job is monetary, their job is fiscal. And so his focus is on monetary. And obviously right now, in light of fiscal uncertainty, it makes it a bit challenging, as he said in his press conference today, to essentially figure out what the landscape is going to look like. He did say that a lot of the data that they're getting as far as inflation and employment numbers look solid still, which really puts the Fed in a position where they are not in a hurry to lower rates. Why would they? Basically, things are stable right now based off of the hard data that they're getting, and they're still waiting for the impact of tariffs. So that was the Fed rate decision today. Now, how does that impact your wallet? I think it's important to kind of bring it down to a ground level here. So according to CNBC, I found this article here, what that means for credit cards, auto loans, mortgages, and more. So the interest rate still, staying the same, 4.25 to 4.5%. So I found basically a breakdown here, right, of the different areas where this could be impactful. So let's take a look at credit cards. Many credit cards have a variable rate, so there's a direct connection to the Fed's benchmark. With a rate cut likely postponed until July, the average credit card annual percentage rate has stayed just over 20% this year, according to Bankrate, not far from 2024's all-time high. Last year, banks raised credit card interest rates to record levels, and some issuers said they are keeping those higher rates in place. At the same time, more people are carrying debt because of higher prices, said Ted Roseman, senior industry analyst at Bankrate. Total credit card debt and average balances are also at record highs. So not a great position if you have a high balance on a credit card. The rates are seemingly going to stay where they are, just over 20%. So, and I thought it was interesting too that right now we're at a point where credit card debt and average balances are at record highs. That is not good. But as long as employment rates continue to stay where they need to be, showing a tight labor market, showing a strong labor market, as Jerome Powell said today, that's good. When it's not good is when we start to see an uptick in unemployment, the job market starts to soften, and you have credit card debt and average balances at record highs. That is a bad combination. So something to keep an eye on. Also, mortgages. Mortgage rates don't directly track the Fed. but are largely tied to treasury yields and the economy. As a result, uncertainty over tariffs and worries about a possible recession are dragging those rates down slightly. The average rate right now for a 30-year fixed rate mortgage is 6.91% as of May 6th, while the 15-year fixed rate is 6.22%, according to Mortgage News Daily. Mortgage rates are showing signs of life after a slow couple of years. Auto loans, basically right now, with the Fed's benchmark holding steady, the average rate on a 5-year new car loan was 7.1% in April, while the average auto loan rate for used cars is 10.9%, according to Edmunds. At the end of 2024, those rates were 6.6% and 10.8% respectively. So with interest rates near historic highs and car prices rising, along with pressure from Trump's 25% tariffs on imported vehicles, new car shoppers are facing bigger monthly payments and an affordability crunch. So that's not great. So not exactly the environment you want to be buying a vehicle in. Student loans is another area. Federal student loan rates are fixed for the life of the loan, so most borrowers are somewhat shielded from Fed moves and recent economic turmoil. From what I've gathered, student loans are generally based more on 10-year treasury note auctions and are expected to drop slightly, according to higher education expert Mark Kantrowitz. Definitely butchered that name. Undergraduate students who took out direct federal student loans for the 2024-25 academic year are paying 6.53%, up from 5.50% in 2023-2024. And then lastly, savings. It's actually a great environment to, if you're not in a position where you have a ton of debt and you can actually save some money. High yield CDs, high yield savings accounts are actually offering a rate right now which is higher than inflation, so that's good, 4.5% on average according to Bankrate. So it might be an interesting place to park some money. So just wanted to again kind of bring it down to a ground level. The Fed rate affects a lot of things, and I think it's important to kind of educate the different ways practically that can impact individuals. While the Fed tries to calm nerves, another storm hit, this time from Silicon Valley. So as I mentioned earlier when we were looking at the heat map, Google and Apple were down today, even though the rest of the market seemed to be up. Basically, Google took a big hit because of a lawsuit that is going on right now. Alphabet stock fell sharply in midday trading, according to Bloomberg, after an Apple executive's testimony pointed to artificial intelligence taking market share from traditional search. So when you think about traditional search, that's going to be Google. When you pull up your iPhone and you go on, the web, you're obviously going to get Google. And basically this testimony was suggesting that they're seeing a transition more now to AI, chat GPT, things like that. Apple Senior Vice President of Services Eddie Q testified in a Department of Justice lawsuit against Google. The searches in Apple browsers fell for the first time as people turn to AI for their search. According to Bloomberg, this comes as the Justice Department investigates the long-standing partnership between Apple and Alphabet, in which Alphabet pays billions for Apple to use Google as its default search partner. Shares of Alphabet were down 8% as the testimony fueled investor concerns that Google might lose its crown as the king of search, as rivals like ChatGPT, Perplexity AI, and Meta AI grow in popularity. So a very, very interesting development, and let's just take a look at Google, which, as I said, took a massive, massive hit today in light of this news, despite the fact that the rest of the market seemed to be pretty steady. For those on YouTube, you can see a big red candle here, and most notably too on really high volume, right? So a lot of conviction in the sell-off today in Google, down, just over 7%, but as low as over 8%, currently trading at 151 after opening around 163. So big dump on Google. And basically, as the article said, the reason for this, Google pays a lot of money to Apple to be the premier, if you will, search engine that Apple uses. And the fact that we're seeing a transition to AI, ChatGPT, right, Perplexity, things like that, Meta AI, is suggesting that they may be in a position, Google that is, where they may not have that partnership much longer, or at the very least, they're starting to lose market share on it, right? And so, obviously, it's affecting investor confidence. Let's take a quick look at how this impacted Apple, because you got to think about it this way. If Google is paying Apple a ton of money to use their search engine and that goes away, that's obviously money that Apple will not be collecting anymore. And so Apple also had a red day, not as big as what Google had, but 1.14%, but still a down day for Apple as well. And I mean, just from personal experience, this makes sense. If I think about myself, when I'm doing research of late, I'm not going to Google, right? I'm going to ChatGPT to, give me a layout for a project, or if I want a quick answer, or if I want a dietary plan. You can use ChatGPT for incredible things, and you don't even have to pay for it. You can just use the free version, and the service is absolutely incredible. So I can see how this can be a concern for, Alphabet investors, right? Big tech isn't the only thing investors are watching, though. We are still in earnings season, which is, in full swing. We saw banks, and we saw some big tech earnings last week, as we talked about, right? With companies like Meta. And so right now, as far as the rest of the week goes, there isn't a ton as far as earnings that are coming out, but there is one that I wanted to highlight coming out tomorrow, which is going to be Shopify, set to release its first quarter earnings report, with analysts closely watching for commentary on the recent policy change by the Trump administration that eliminates the tariff exemption, right, for inexpensive Chinese imports. So this policy shift could affect Shopify's merchant base, especially those sourcing from platforms like Temu and Shein. So something to keep an eye on for Thursday. Beyond that, I didn't see a whole lot. Of course, there's other earnings, but as far as like big notable companies, Shopify is definitely one to pay attention to. Walt Disney reported their earnings, which seemed to be pretty good. You had Uber that came out with earnings today, Supermicro Computer as well. So all things to definitely check in on. These are, I like to put it as like a quick temperature check, right? Is basically what we're getting off of some of these reports. And again, I want to see if these companies are continuing to, if they're going to show guidance, right? If they're going to pull guidance. These are important things to pay attention to. I would venture to say a lot of companies would pull guidance in light of the tariff situation. They want to wait and see how things pan out, especially for those companies, especially in discretionary sectors like, with Shopify being in, more of a discretionary sector, definitely impacted by China, of course, right? And so be curious to see if they have guidance or not tomorrow when they pull out their earnings. Just as important as earnings, tomorrow morning brings a key economic report, definitely one that Daddy Powell and the Fed are going to be paying attention to. That is jobless claims. This is coming out tomorrow. And this is one of the more, as I mentioned on Sunday as well, this is one of the more volatile economic reports that we get. It comes out at 8:30. The previous number was 241,000, expected 231,000. So we're expected to see a softening in initial jobless claims, which is good for the economy. So let's hope that, it comes in like that. Now, if that number comes in hot, that could be the beginning of a kind of red flag for Jerome Powell and the Fed, and might be one of the pieces of data that gives them a bit more confidence to potentially do a rate cut in June. But as Jerome Powell said today in his press conference, as of right now, the data looks good. And so they're going to sit on their hands, and they don't really see a reason to start cutting rates. I would imagine, though, when they do start cutting rates, I did hear that we could basically see rate cuts happening in consecutive months for the remainder of the year. That obviously is yet to be seen. We'll see what happens, of course, as time passes. But as of right now, as I mentioned earlier, it seems like we're going to stay at 4.5%. So initial jobless claims come out tomorrow morning. Definitely pay attention to that. Definitely will be something that moves the market. And last but not least, for those of you building your long-term game, we've got something special coming. We will continue our investor series on Benjamin Graham, the father of value investing, the guy that mentored Warren Buffett. I don't know if you've heard of him or not. He's only one of the most successful investors of all time. And so this weekend, I will be doing part 2 of that series on basically investing versus gambling, right? We're going to break down Graham's rules for smart investors. We're going to break down speculating versus investing. We're going to break down margin of safety and what that meant to Benjamin Graham. And so that'll be coming out this weekend. So definitely like and subscribe so you can get notified on that. And if you missed part 1, it is up on our YouTube channel that I put out last Saturday. Just an introduction to who Benjamin Graham was. So definitely worth checking out. And also want to throw in a big thank you to all of you. We started this channel at the end of January, and as of today, we have officially hit our first milestone, 100 subscribers. Thank you, thank you, thank you. And looking forward to the journey to the next 100. So again, like and subscribe, follow us wherever you listen to podcasts. I will be back on Saturday, of course, for that part 2 on the investing series. And then Sunday, as always, we'll do our market breakdown for the week ahead. Stay vigilant. And as always, folks, remember, plan the trade and trade the plan. Have a good night.